Who am I? Well, Terry kindly introduced me, but so VisionFR, whilst we are currently, and this is what we do, we are finance recruitment people. The founders, both myself and my partner Deborah, we are both former board level directors. We've worked at a number of marketing agencies across the various sort of marketing disciplines. Myself, probably more specialising in the PR sector. So we've got quite a lot of experience of running, from a finance perspective, these sorts of businesses. And that's what I'm going to try to share with you today. I suppose it's also worth predicating this on, there's a bit of an assumption here that most of the businesses in the sector are still working on a bit of a time-based method. We're still, to some extent or another, doing timesheets, and I'll come on to that a bit later in the presentation. So that's a bit of an assumption, and that's what section of the session we'll cover. We'll cover a little bit about the sort of the broad financial model, a little bit about contractual things, because, you know, as account managers, account directors, you're probably increasingly getting engaged with suppliers, and you might need to know some things to watch out for there. As I mentioned, we'll look at time and why that's important in this sort of business, and then increasingly so in the current times, you know, cash flow and the role that you can play making sure that runs as smoothly as possible. A couple of things just to note before we sort of launch into this. I think there's a usual sort of Zoom chat facility. If you've got any questions, if you can load them into the chat facility, then what we'll try to do is take those at the end of the session. I'm hoping, I haven't tested this fully, I'm hoping this will be around about sort of 45 minutes worth of me talking, and then we can have a little bit of a Q&A towards the end if that works. That works for you. Now I'm just going to switch my view off so I can actually see the rest of my screen. And here we go. Or do we? There we are. Okay, so how we operate as a business, and right back to the sort of fundamentals. And again, this may sort of change slightly agency for agency, but ultimately we're going to get a client budget, and the client budget is going to be spent on fee, and that's effectively what we are doing to deliver the scope of work that we have agreed with the client. There's going to be an element of pass-through costs or project costs, and certainly in the old-fashioned days we used to try and make a markup on project costs. I know procurement are getting tighter and tighter on that, particularly the bigger clients. So we've got to manage our fee element as well as possible, because there's limited scope now to sort of compensate for that with markup elsewhere. And then I know some businesses, again, and this maybe comes from my background in PR, there's a little added extra that they charge, which always sort of surprised me that procurement didn't always pick up on this. But this is, I always call this a charge for the variable costs associated with running an agency. So some of those things like, I don't know, subscriptions, maybe insurances, which largely sort of depend on the size of the project or the client that you're working on. It might be a relatively small amount, and certainly in the agencies that I've worked at, we were charging sort of 2 or 3% of fee as a little bit of extra revenue stream. Now, I realise that a number of clients won't permit that, so I just put that into the mix because I know some of you may do that. And where does that, the fee income, what do we make out of that overall pot of client budget? Well, we make our fee, we make our little bit of margin on project costs, if that's permissible, and that account running costs. So that's our fee income. And where do we typically spend that as an agency? The lion's share, as I'm sure some of the senior people in the audience will know, goes on to into our staff cost. And we really do need to try keep an eye on that. That is the key driver. If we can keep that at 60%, we're doing pretty well. If we can get it down to 55%, which is probably the ideal target, then we're doing very well. However, if it starts creeping too far above 60%, as we'll see later, that can fairly quickly sort of turn into a tricky situation for businesses where we don't have a lot of margin for error. We spend about 25% of our fee income on overheads. Some of those are fixed. Some of those are a bit more discretionary. So discretionary costs will include things like training budgets, marketing budgets, are things that can sometimes get squeezed if the going gets tough. And then we're left with a balance which is profit. And we seriously ought to be striving to earn 15 to 20% as a profit margin if we're running a very well-run agency. But that staff cost management is key, and more on that a little bit later. A little bit on profit. I know sometimes we're not keen to talk about profit, but I think it's really important that we don't think of it as a dirty word or something that we ought not to be in some ways proud about. Where does it go? Well, it goes into things like bonuses, training, developing a culture, well-being. Really importantly, it goes into developing new services and products, maybe hiring new talent with new skills. Capital expenditure, new IT kit, office refits. You might not be having too many of those right now, particularly if we're all working from home, but that's typically where it's gone in the past. And then there is a big balance that goes to corporation tax, and then businesses will retain a certain amount of the profit each year, potentially for future investment, but also for that rainy day. And the situation we've got with COVID at the moment means that those businesses that have got that bigger retained reserve are going to be doing, they're going to be having a slightly easier time of it than those who maybe haven't had the opportunity to build that up. But profit also provides opportunity, and this is the really important bit. And if you've got a vision for your agency, then having profit enables you to get there. It enables you to grow, and growth is important because it gives all of you employees career development. It gives you promotion when you deserve it. It gives you bonuses when you've been working hard, and it really importantly allows you to work on new and exciting initiatives. You can invest in new stuff, things that make you a bit more cutting edge. And clients like that as well. They like having high quality people, and they like the opportunity to be at the forefront of new services. So that's why profit is a good thing, and trying to openly talk about it in that sort of way is not a bad thing from my perspective. I'm going to, before we go back into time, I'm just going to look a little bit at contractual things and some of the tools that we work with. So these are probably, I'm not going to go into as much depth as maybe I would do in a longer session, but things that you may come across, NDAs or confidentiality agreements. There's many a time when I've had account directors come to me and say, yeah, hey, Greg, I've got the contract with the client, and I go, okay, no, that's just the NDA. It's an important tool which is about respecting each other's confidentiality at the outset of a relationship. But that then gets superseded by the contract or master services agreement. And before we get to a contract or master services agreement, sometimes we've got to produce a budget. And certainly we have to produce budgets for new projects as they come in from time to time. So budget template could be sort of second or possibly third in this row here. But we'll talk about budget template in a moment, and we'll talk about the contract and master services agreement, which is an overarching document. And then the really important thing, primarily from your guys' perspective, is a statement of work. And that's the thing that really from project to project dictates how much you want to charge for the scope of work, what you're going to do within that scope of work, what the KPIs might be, what the time frame might be, all the stuff that is really pertinent to a particular project typically goes in a statement of work. So a contract MSA might have several statements of work hanging off it, all governed by the same master terms, but statement of work, maybe a one-page document with a PowerPoint presentation that goes behind it and a budget template. That's the sort of thing that you're probably going to have from project to project. And then I've touched on supplier agreements because, as I say, I think you're probably dealing with suppliers on a regular basis, and you just need to know some of the the key watch outs there. We'll come on to that. Lots of words on these, so I'm going to canter through in the interest of time, but effectively our budget. This is going to cover our fee, our project costs, which may include markup, may include those account running costs. Don't worry if those are not necessarily quite relevant to your agency. Fees important and project costs will be. And fee is, to my mind, and still for most procurement personnel at client end, is largely still based on our time. It's what is the time, what is the expertise that we need to deliver our services. Now, we've got to make sure that we're not deluding ourselves here. There's a load of upfront strategy, good senior time that goes in, good upfront creative time. It's not just about that delivery piece. We've got to make sure we're capturing the upfront time as far as we can do. Media influencing, delivery, account management, creative services. It's not an exhaustive list, this, but let's be thinking about all the different components that go into a particular project or campaign. I touched a little bit on value here. I know this is something that a number of people in the industry are talking about, is, you know, should we be talking about value pricing rather than bothering with timesheets and what have you? I think it's a laudable idea. I'm not quite sure we're there yet. So, you know, there are some fairly fundamental questions about how you measure value, how you determine your contribution versus another agency's contribution, other things beyond your control. And importantly, can you agree with a client what the KPIs might be upon which you're going to be measured? And then how do you apply a value, a fee, and a monetary amount to that value that you're agreeing on? So to my mind, whichever way you do it, it's still underpinned by knowing what your time is, what time you're spending on particular projects, or at least trying to estimate that in the best way possible. So fee is the number of hours across the various personnel within a team multiplied by the charge out rate for those team members. And they will differ from team member to team member. Sometimes agencies may work on blended rates. I tend to prefer not to, because I think it sometimes loses the high value upfront strategy and creative time, but that's an alternative. And you're trying to estimate the time when you're putting a budget together. And it's not always easy. This is where it can kind of go wrong. Clients can squeeze you, or you may just try to be working to deliver that fabulous proposal within a fixed budget, and you'll do whatever you want to make the numbers work. Well, I would urge you not to delude yourself. You know, really think about what the reality is in terms of the time required to deliver a particular scope of work. And then if it needs someone to make a decision on whether it doesn't quite work, but you really want to run with it, then at least, you know, refer the reality to your senior board or associate directors so that they can make the call on it. So you've got to look at the seniority of the team. Don't forget the upfront planning and strategy time. Creative resource. Make sure we're talking to the various team leads to understand how much time we think might be required to produce a video, a website, whatever it might be. Things like meetings, account management, measurement, evaluation, well, maybe we can be smarter about that. Maybe we can squeeze that a bit more, and particularly now that we're all used to working on Zoom calls, well, maybe, oops, over one. Maybe that can be, you know, maybe we can make that slightly more efficient as we go forward. Then I've added project costs and ARC onto this particular sheet, and I've got that on the next one as well, so apologies for that. But yes, we want to be thinking about our third-party costs and out-of-pocket expenses. And if you're relatively new to this, you know, how on earth are you going to learn unless you're talking to your seniors? You know, talk to them, find out. There shouldn't be any pressure on you to come up with the ideal budget at a relatively junior level. You know, I think it's perfectly reasonable to be getting the approval and input from your seniors, so don't be afraid of that. And what I would also try to do, particularly if this is a new project, a new service, or something we're not quite used to delivering, maybe it's got a particularly long time frame, let's look at putting in some sort of contingency. And that could be a contingency not just on the fee, but maybe also on the project costs as well, because with the best will in the world, you might not have been able to get a fixed negotiated price with a very specific brief to your third-party suppliers at the time you're agreeing with your client. But what you can do when you are agreeing your project costs is you can get several quotes. Don't just take the first one. You know, it is your client's money that you are dealing with here, and you want to be giving them the best value that you can do. You want to be negotiating you know, for the right sort of quality, but at the right price for your client. So negotiate, and then make sure we've got the pertinent points covered in an agreement. Quite often we might just accept the supplier's purchase order. It might not cover some of the things that we need it to cover. I'll talk about that in a moment. This is my little sort of virtuous triangle. If we can get our budgeting right, so if we can understand what tasks need to be done, we know who needs to do it, roughly how long it's going to take, then we can equate that to a fee. And if we can agree that with our client and we can deliver on that, then this is a sort of, as I say, the virtuous triangle where everybody, client side and staff side, is happy. Of course, it doesn't necessarily always work out that way. This is probably more for senior people who might be on the call, but just so you're aware of it, the MSA, so the MSA is the overarching terms under which we do any piece of work for a particular client, usually agreed at the outset of the relationship, sometimes renewed at periodic intervals. And some of the key things that we want to be watching out from a commercial perspective are, what is the term, how long is it going to go on for, and what notice period are we up for? The commercial terms, things like payment terms, doesn't necessarily cover invoice cycle. I would prefer invoice timing to be covered in each statement of work. But two other really key ones: liability. So we should never be entering into a contract with a client that has an uncapped liability. If something goes wrong, yeah, not necessarily something that we had full control over. What we don't want the situation to arise is where the client could really take us to the cleaners and potentially damage the business for good. So having a liability which is linked to the work that we're doing, and certainly is covered by the insurance policies that we'll have taken out, is what we need to make sure we've got in an MSA. And intellectual property rights is a big thing, which I really think we could probably spend a whole session on. But effectively, we don't want to, in an ideal world, we don't want to be giving away our intellectual property rights. I've had situations where we might have done a website design for a client, and two situations. We do a website for the UK. Oh, can we go use that globally? Or can we use the design that you did for the website on our product packaging service? Well, depending on what arrangements you've got in your contract, your MSA for intellectual property rights, they might be able to do whatever they like with it, unless you've carved out that they might only be able to use it for a specific purpose. It's a bit of a battle, that one. But it's a really important one, and it's up to you to some extent at a senior level as to how much you want to fight it. But it's worth knowing at a sort of mid-junior level and trying to understand what rights are there, because when it comes to dealing with suppliers, you want to understand what the supplier arrangement is, because there may be a consequence in terms of your client arrangement. The statement of work, though, we talked a little bit about this just a moment ago, but this is where this is probably the one pager, 1 or 2 pages at most. It's not a heavy legal document because that's all in the upfront MSA. This is where we agree what we're going to do for the client, maybe supported by a sort of PowerPoint proposal or something similar. But it's got to have in, you know, what are the key dates and milestones? What are the KPIs? What's our budget? When are we going to invoice? Again, cash flow we'll cover a bit later. Can we have a sort of cancellation clause or notice clause for a particular project? You know, it used to be the days where agencies used to be on quite nice big retainers, and if a client served notice, you were on 3 months' notice, and you kind of knew where you stood. You were going to get your retainer paid for the next 3 months. With what seems to be an increasing move towards project-to-project charging, where clients seem to be able to just cut projects whenever they like, and they can do that almost overnight. Unless there is something, I think in these statements of work or in the project agreements, whatever you happen to call them with clients, that handle how you deal with project curtailment on a project-by-project basis. And it may be, when I talked about intellectual property rights, that maybe there might be specific intellectual property rights clauses for each particular project as well. Just checking on time, we're doing okay. A supplier agreement. So again, similar sorts of things that are important, but don't just willy-nilly go and sign off something with a supplier, particularly one that where there is a significant cost or some value. And it's also important, particularly with people, you know, influencers, bloggers, vloggers, people who are actually going to, you know, potentially create something for us, endorse something. You know, what are the terms that we want them to operate under? So what sort of exclusivity have we got? Are they going to be able to go and do this for our client's competitor? Do they have any liability? Should they? It seems like a lot of these influencers don't have any sort of serious liability insurance, and to my mind, they could do untold damage if they said the wrong thing. But you know, they want the fee, but they don't necessarily want to pay for the insurance. So that's one to watch, I think. Again, intellectual property usage timeframes. So how long can we actively promote this thing for? Is there a restriction on where we can promote it? Make sure these things are all very clearly understood at the outset. Scope of work and deliverables, I think you're probably a bit more familiar with, as in, and also time frame and dates that you're expecting things to be delivered. And then, you know, budget. We talked just a moment ago about a budget template for fees and costs. But a payment schedule for each project is really key. This is where we can influence cash flow. I'll come on to cash flow towards the end, but just here, what we need to be really mindful of is that we don't want to get into a situation where we're having to pay our supplier ahead of getting money in from the client. And it quite often happens where suppliers will say, I need 50% up front. I need 50% tomorrow on signing the agreement, and I need 50% before we actually you know, finish the day of production. Well, that's kind of okay, but you need to be having that conversation with your client as well to get those terms mirrored and understood by the client. And quite often the client is amenable to that, but they need to be in the conversation from an early stage. And again, what's the situation with termination and cancellation? You know, if you cancel something, goodness knows, I don't actually know what some of the arrangements may have been with COVID, but I dare say there are a lot of things that were needed to be cancelled, venues that needed to be cancelled, and so on. And there were probably cancellation clauses that we're on the hook for, and hopefully clients you know, respected that and have passed that through. But again, that's having an understanding and full knowledge of what you're entering into is really important. So just to recap on that contracting piece, confidentiality requirements are covered in an NDA. primarily until they're superseded by a contract and MSA. Ensure budgets are accurate, reflect what we need to do, learn from other people. Understand what our particular obligations are that we as a delivery team, some junior people who maybe not have been involved in the nuts and bolts of the legal discussion, how does that impact on us? Is there anything that we really need to know? Make sure we're very clear about what's required in a statement of work. Make sure your team is really clear about what's required in a statement of work, so that if a client starts asking them to do a little bit of this or a little bit of that, which is extra, somebody can raise a hand and say, okay, what do I do about this? I'm being asked to do something which isn't what I was expecting. It's beyond the scope. Should I be asking for more fee? Should I be replacing something in the current scope with the new stuff that is being asked of me? Unless you know what's in that original scope, you don't quite know when to ask that question. And understand, negotiate with your suppliers. Okay, time. Okay, I'm assuming that most of the agencies that you're representing on this call are probably still selling time. It's kind of what we do. We get paid roughly in relation to the time that we work, and we sell time to our clients based on what we work. So it's really important we get this right. We can package it up in different ways, but we really need to sort of understand the cost of doing work, and roughly, I didn't think roughness about it, that is directly related to the amount of effort and time that teams are putting into a project. We need to ensure that we appreciate that time and that the client appreciates the value of that time. So we've got to be delivering good stuff, but the client has got to understand how long things take and work with us if things aren't quite working as we'd like them to. I'll touch on that in a moment. And what we really don't want to be doing, and I know it does happen, is we don't want to be writing off time and giving it away for nothing. There's a lot of hard work that goes on in agencies over and above generally that scope of what we're talking about, and very hard to recover all of that. So getting that virtuous triangle right is the holy grail, really. A little bit of a recap, and just to emphasize the point, managing staff cost to fee income is the real key thing. Agencies that have been able to manage that staff cost fee income at a good level, let's say circa 60% or below, will probably have found it a little easier to weather some of the COVID storm, certainly in the early stages, than those that were pushing beyond the bounds of this and didn't have an awful lot of flex in their budgets. So keeping on top of this as much as possible is really key. We talked a little bit about hourly rates. So your fee is the time that you're going to spend multiplied by a rate. Well, how is that rate calculated? There's a bit too much detail to go into to be completely explicit with it, but effectively rates do make an allowance for covering your staff cost and all the other overheads of the business, whether that is marketing, training, development, business admin, and they are also designed to cover the profit element that we want to make, and then how much time in a given year we all have to work in the business. But rates do allow for non-billable time as well. There is no expectation that you are going to be working 100% of your time on client work, generally. Some of you might, but on average, a business will probably spend something like sort of 65 to 70% of everybody's time will probably go on client work. And so that allows a fair chunk of work to do some of that business development, the new biz work. Some of the new business pitching, and I know that's a real tough question about how much time gets sucked into into new business work. But and again, probably one for another session. But there is generally an allowance within our rate cards and the model of the business to spend time on business development, business administration, and some of those support functions. And kind of inevitably, there will also be an element of write-off. I have to say, I don't think I've ever worked within the business where there has been no write-off across the piece. And we've just got to try and manage that. And I think if you can keep your write-off levels to less than 10% and therefore be charging more than 90% to clients, we're doing pretty well and the agency will be pretty successful. So we've got a few things that we're trying to weigh up here. Utilization is the amount of time that we spend on client work, and there's a roughly about sort of 60 to 75% of that. And write-off we should be trying to keep at less than 10%. And there's a little illustration of that for you coming up. Normally, if we had a bit more time, I would sort of give you this exercise to do, but I think we'll be sharing the slides so you can maybe go through it in your own time. But imagine you had a consultancy, 10 people, £100 an hour hourly rate, and they were doing 45 weeks per year. Let's assume the staff costs in total were 620 and other overheads were 280,000. Well, if you were working and charging to your client 25 hours per person per week, so that's 25 hours for 10 people for 45 weeks a year at £100 an hour, if you multiplied those up, you end up with £1.125 million of the fee income. That would deliver, having subtracted our staff cost and our other overheads, a profit of 225,000. And that gives us what we call a profit margin of 20%. So that's the profit number, 225, divided by the fee income, which is the money that came into the agency. And that gives us a really nice sort of 20% profit margin. It would also give us a staff cost fee income, that's 620,000 staff cost as a proportion of our fee income. So that's what we're talking about with this sort of 55 to 60% piece. It would give us a staff cost fee income ratio of our ideal 55%. And assuming that this was a sort of standard, I say standard, I don't know what's standard these days, but let's say it was a 37.5 hour working week. So it excludes lunch breaks. It's a sort of 9 to 5:30 sort of business. Then you'd be looking at a 67% utilization. That's sort of, if you like, an ideal model. Now, and it assumes that on average, everybody's charging 25 hours per week to a client. Here's a little example of what happens if those hours per week shift a bit. So if we are only charging 20 hours per week, then all of a sudden our profit is wiped out. Our staff cost fee income has gone from 55% to 69%, and the amount of time that we're collectively spending on our client work is only just over half the time that we're in the office. And that's actually what we're getting paid for, to be honest with you. So we're getting paid for 53% of the hours that we're spending. And you can see as that works its way through it, as you go from just small fractions, make fairly big differences to your margins. Now, I think when you get up to those higher numbers, a 25% plus profit margin is probably rare in practice. And all of these businesses, they have to get a balance between delivering to existing clients and that non-client time, which needs to keep the engine fueled for future growth. So tricky to sort of run at a really high profit margin unless there's something, some nuances maybe within the business. So final bits on time. So what we have to do once we know what projects we're working on, we have to forecast the time. So we have to use our rate card, which we've agreed with the clients. We've agreed our budgets, and we have to sort of forecast when we think this project and or the collective projects are going to be delivered, and that sort of helps us plan a profile of our the team required from a month-to-month basis. I've seen some accounting software tools that help with this. I think there's some that Paprika try do. There's some that Deltec try do, and there are some pretty sophisticated spreadsheets that some agencies may cover. None of this is ever going to be a specific science, but the more of an understanding you can get, the better. And this is mainly coming from your sort of finance director and your finance team and your resourcing, the better idea of what sort of team shape you're going to be needing on a month-by-month basis. Timesheets. Well, hopefully you can understand that time is an important factor. Whether you're charging it as value, whether you're charging it directly in relation to fee, it's a really important thing in my mind. And I'm speaking with a finance hat on, that we understand what time is being spent each day. If we don't know what people are doing, then it's hard to try move things around to create a better sort of work-life balance, I guess. So you need to understand all the time that is going to clients on the right sort of projects. It just needs to be instilled from top down. And if it's not instilled from top down, it's very hard to start creating this sort of discipline. Complete them daily. It's a lot easier to do that. And just put all the time down. If you're working till 10 o'clock at night, somebody needs to know that. Don't just try delude everyone by saying, oh, I've only done 8 hours today. Otherwise, you'll be working till 10 o'clock every night. No one can learn from it. And this is my point here. Reviewing time is all about learning, and it's all about improving. It's not about beating people up, and it should never be about that. We need to do 2 things. We need to know how much fee can be recognised each month, because we want to have an idea about what we've delivered, what was the time requirement to deliver that, and how does that correlate to the fee that we can recognise. That's a financial element to it. We want to ensure that clients are getting what they've paid for, and that we're getting the recognition of that. But we also want to see where there might be issues within the business. If people are working too late, we probably need to know that and understand what's causing it. And we want to learn from it so that when the next budget comes around, we can correct it. We can have conversations with the client. There are probably lots of different approaches to this, but when you're reviewing time, you're looking really at what you're expecting to happen versus what really did happen. So that's kind of why you need the timesheet information pretty promptly. Otherwise, you're reacting far too late in it. So I just encourage you to try and instill that discipline of doing timesheets. It's for everyone's better good. It's not just so that somebody can beat you up and say, well, you spent too long doing X, Y, and Z, or it shouldn't be. Fee recognition and invoicing, slightly different things. Fee recognition is largely dependent on the deliverables, the milestones that we've achieved, the time that we've committed to clients. Invoicing may happen at a slightly different timing to that. It could be that we invoice upfront, we invoice in arrears, we may have different schedules, but they can be 2 different things. And it's just important to understand that, particularly when you're sort of account director level plus, that fee recognition, which is what goes into the business's monthly management profit and loss account, versus invoicing, which is a cash flow, cash flow piece. I'm going to just race on a little bit, but if things don't go according to plan, we end up with probably too much time having been spent on projects, and we end up with write-off. I'm assuming write-off over service, time given away is probably what you've heard discussed at various parts of your agencies. And some of that write-off might be okay. We might have planned for that. We might have got the green light to go ahead and deliver a bit more to a client because we want to deliver a little bit over and above. There may be a particular issue that needs resolving. So that's proactive, should be signed off by someone more senior in the team and not used just as any old excuse as to why we've got a write-off. But if we have unplanned write-off, then we might have a bit of an issue bubbling. And the most important things here are is that we understand what's happened, why, can we learn again from it, improve from it, talk to the account leads, and then we might need to be talking to the client. And there are generally sort of three ways that, in my view, that we end up with this sort of write-off. One is that work was out of scope. Client asked us to do things, or we didn't quite understand the scope. Maybe we didn't quite budget it correctly at the beginning, but again, we've got to learn from that. So ensure we understand that, ensure it's detailed. There's a point here about number of amends. Well, how many times do we sometimes go back and change things because the client changes their mind, or because the client couldn't get everybody in the room to approve a piece of work at the same time, and it involved 3 different changes as opposed to maybe 1 change. It's some of this is about work in practice, but let's try agree how many amends we're covering. Make sure your team understand their scope of work and they're waving a hand when they see an issue or something that takes them beyond that. And maybe if we've done a bit too much up front, then maybe we can tweak things a little bit towards the back end of the project and reduce the scope further back. Unless we know that and we know where we've got to and properly reviewed it, then we'll just end up over-servicing by the end of the project. This sometimes happens, fairly understandable. We might not have all the right people at the right time, the right skills. It's a tricky one. There may be a training need. Maybe some people are being asked to do something that we thought they were capable of, but perhaps they haven't been trained on it, or they're just not quite as quick as we thought. Can we learn? Can we improve their skills? And sometimes we just can't get the team shape right. We thought we were going to do this with an account executive, but an account director had to do the work. It happens. If you know it happens, then you can kind of control it. You can, maybe we can have that conversation with the client, or certainly we can acknowledge it internally that we need to start thinking about moving the teams around if we can possibly do that. How do we improve it? Training, coaching, where possible, adjust the team. And this is always a key one, I think. We thought we were going into a nice sort of working, smooth relationship with the client where things are going to get signed off, purchase orders are going to get raised and so on, but maybe they just don't. Clients can be a bit awkward, but the only way we're going to improve that is by identifying what's going wrong and talking to the client about it. And my experience, clients kind of like this bit, particularly talking to procurement. Procurement are all about sort of trying to reduce cost, if you like, but if you can try explain some of the things that are causing our angst and our difficulties, then they can sort of help move things around and help be a bit of an advocate of change sometimes. So round upon that, before we just get on to the cash flow piece, I'm hoping we can just squeeze an extra 5 minutes or so in. Ensure we're producing clear statements of work. You may have different terminology for this, maybe project agreements or working statements, but it's the same sort of document. Make sure the team understand them and know who to talk to when things aren't included within it. We record time, we review time. And it's important that this is all about learning and improving. We recognise fee in respect of work done. That might be milestones, it might be deliverables, it might just be a time-based work done. But if things aren't happening as we want them to happen, then we've got to find out, talk to the team, talk to clients, Again, learn and improve. And for you guys here, you can talk to your junior team members. Make sure they understand what's required of them, and make sure they understand that actually doing timesheets isn't a big evil. It's just helping us sort of run an effective business. It's about trying to make their lives easier when sometimes they're probably they're feeling right up against it. And you may need to adjust your forecast a little bit if you haven't done quite as much as you thought. You haven't progressed through a project to the same degree as you're expecting, or maybe you've done a bit more. This is a finance thing that they should be helping drive, but you can be adjusting your fee forecast as well. So, hoping you're still with me. Cash flow basics. This is relatively straightforward stuff, but let's just assume here we're going left to right. If we invoice to a client in advance at the beginning of the month, knowing that they're going to be on, let's say, 30-day payment terms, then we get that money in at the end of the month. Bearing in mind that a fee invoice is largely designed to pay for most of our staff costs, 55% of fees, 60% of fees is covering staff costs. We've got a big outflow at the end of the month, so we need to be making sure that a client is sort of paying us roughly for the work that we've done in that month to coincide with paying our people for the work that they've done in that month. That's the nice idea. And the same thing applies in respect of project costs. We want to be trying to invoice the client sufficiently ahead to enable them to pay us ahead of us being required to pay our suppliers for the project cost. So that works. This bit kind of doesn't work. So let's say we invoice clients in arrears. So we do the work in the month, then we raise the invoice. Or maybe the client delays getting us the purchase order and we actually don't invoice it till maybe the beginning of the next month. Well, we've already had to pay the salaries out. So we're already behind. And I think you can probably see from that how that just becomes a really sort of challenging cycle of events. And really what you're relying on is the fact that you've got some clients here, maybe at some point you build up some sort of cash flow, or you're relying on the bank overdraft or something to sort of help fund this gap. Now here's another one, okay? Maybe we can invoice the client at the beginning of a month, but they're going to take 60 days to pay us. Some will take 90 days to pay us. And again, you can see, okay, well, we get to a sort of neutral position roughly by the end of the second month, but we've got this period here where we're bridging again because the client is taking long to pay us, and we've agreed with, not necessarily with our staff, we have to pay them when they're due. But if you're converting this into a situation where this was project costs going out, well, if you've agreed to pay project costs on a 30-day payment term, but our clients are on a 60-day payment term, then that's a bit of a problem for us. So let's always try negotiate with the supplier to mirror at least what our client is asking of us. Or if we've got some fairly chunky project costs that we know need to go out promptly, then we have to have a conversation with the client that takes us slightly outside of their normal payment terms. If not, then we can say to the client, well, maybe you want to pay these people yourself. These are, I'm not saying that there's a silver bullet for each of these. These are all discussions to be had with clients, but there are slightly different approaches, and people just need to be mindful before launching into agreeing with suppliers how, we talk about the supplier here, how the impact of agreeing supplier terms is felt elsewhere within the business. So this is one where we have to play a supplier up front. Artists particularly like that or need that. Even if we bill the client promptly, excuse my typos in here, we might still be 30 days out of pocket again. So it's just about being completely cognizant of what the client payment terms are before we agree supplier payment terms. This is one where it sort of works a little bit better. where everything is sort of being invoiced up front and paid on 30 days. So I just want to come to a quick summary and then we can take some questions. That's been useful, but what we've covered, some of the main things that I've taken out of this is staff costs. Managing staff costs is the key business driver for pretty much all agencies at the moment, unless those agencies are delivering sort of licensed products or something that has a very different sort of billable model. The assumption here is that this is a service industry charging for people. So managing your staff cost is key. A budget is our fee and our project cost. You know, let's budget with care, building contingencies, make sure we're reflecting the experience and the team that's got to deliver it, and don't try to cheat ourselves. Really, it's just a headache awaiting us. Understand the difference between the contract and the SOW. For most of you here, your involvement is going to be around, you know, what's the content and scope of a statement of work for each project that we're proposing to a client. And supplier agreements, again, I highlight this because you're probably more likely to be dealing with suppliers. That's my assumption, at least. And therefore, you need to sort of involve the right people. I'm not saying you guys are necessarily going to be the ones who had this legal negotiation. You're probably going to be pulling in your finance team, maybe a legal team support if you have that. But these are the key things that you need to be aware of. And maybe you're the one who goes back and discusses it with your supplier. Exclusivity, liability, intellectual property, and so on. Time, we're forecasting, recording, reviewing, but it is all really about learning and improving. Can't emphasize that enough. And then the piece on cash flow is let's aim to invoice, receive money from a client before we have a requirement to pay that supplier. That probably needs negotiation on both sides to a degree. And I think I should have had a nice thank you slide at the end there, but I don't have one. So apologies for that. But that's taken us towards the close of my my slides. I'm happy to now look at any questions. I haven't been able to see them as they might have been coming in. So